Welcome back. Now, market regulator SEBI in its latest circular has released several changes for the mutual fund industry. Vinnii is joining in with more details on that. Vinnii.
Hi, afternoon. So firstly, let's talk about some of the important changes coming on the equity front. Now, first about the value and contra funds. What have they said? Now AMCs can offer both value as well as contra funds. Previously, it was only limited to one for AMCs. So that's a positive for AMCs over there. Other than that, overlap. Now sometimes there are sector and thematic funds which have an overlap with your equity funds. Now there is a restriction in terms of the percent of overlap they can have. What have they highlighted? That maximum 50% overlap between sector or thematic funds versus your equity schemes that you have. If a fund has or AMC has these categories, then you cannot have more than 50% in terms of an overlap that comes in for sector and thematic funds with your equity funds. Other than that, there's a restriction in terms of which sectors or themes, these fund houses are picking up, right? Now that is what has also come in as that they have to and follow this AMFI's half-yearly approved list, which has the new launches, will follow this list of sectors and themes that may be defined by AMFI in this list. That's only where you will be able to launch your new funds. Now, apart from that, residual investments or a residual amount portion that is left with these funds. There's an interesting one that has come in there. They said that now you can include gold, silver InvITs in this residual portion of investments for fund houses. So again, gold, silver investments maybe gives a hedge against the volatility that you see or uncertainty across the globe. It's a safe haven. It's kind of that sort of an investment, so protects your portfolio as well in terms of that. And now, how do you have to comply with all of this, right? That minimum 50% rule for sector and thematic funds, that's not going to be immediate. That's not possible for them to do it immediately. So it's a gradual path over a time period of 3 years. By the end of 3 years, then they would have to follow this restriction. So 3 years, it's a time window for the compliance of this matter as well. So obviously, clearly for investors, what it means, clear scheme differentiation that eliminates maybe any confusion that investors have. Gold, silver, like I mentioned, gives a portfolio protection. Monthly overlap disclosure that this will come in as will help better decision making for investors as well. Now on the debt fund, there's a new category that's come in, that is a sectoral debt funds category. Also, they've highlighted the credit quality that comes in. That's going to be AA plus rating minimum for sectoral debt funds. So that's going to be key because that makes it safer in terms of when you're investing in the debt funds as well. Apart from that, ultra short to short term funds, now they'll have a 6 to 12 month time period as well. Previously, it was a 6-month time period. And also, let's move on and talk about the changes that have come in on the arbitrage fund. First, there was a rule that they could have a flexible debt investment. Now that rule has gotten a restriction, debt restricted to government securities which have a maturity of less than 1 year and repo only. That is where they will have to make that investment. So, a bit of a stricter rule coming in for arbitrage funds. But what does it mean for investors in terms of arbitrage funds? Become safer. Returns could be a bit slightly lower, but at least safer in terms of the compliance timeline for this is going to be 6-month time period. Other important change is solution-oriented funds, the category that was there, whether it's a retirement fund or a children's focus fund, that is going to be stopped. So subscription for that is going to be stopping immediately. There's a new category that has come in, that is a life cycle fund category, where the new category will have a tenure between 5 to 30 years as a tenure, and maximum 6 active funds per AMC is what they can look at in this category as well. What does this mean for investors? Importantly, investors in solution-oriented schemes will have to shift maybe to other categories. And life cycle fund may come with higher exit load, which may maybe increase costs for investors, is what we're understanding. And this is according to Anand Rathi that we're picking up this explanation as well. So this will be important to see in terms of solution-oriented fund. Subscription has stopped, and now there's a new fund that is there, that is a life cycle fund that comes in.
All right, Vinnii, thank you so much for that comprehensive analysis. But moving on,